Hello, traders. Welcome to a new week of trading. This is John Kicklighter, Chief Strategist for DailyFX.com. I'm here to talk to you about the major fundamental themes that we have this week, and that includes a lot, especially because we are coming off some exceptional volatility through the end of this last week. A lot of this has been instigated from outside of the normal bounds of risk on, risk off theme. We typically like to look for big drops in the S&P 500. And while we did get something like that, it really didn't initiate here. And it hasn't really initiated on I would say, the most noteworthy piece of event risk over the past month. That would be the FOMC rate decision. All right, this is a move that is instigating or building up from a catalyst that we don't normally look to, but is proving very much a major market mover. And more importantly, it's tapping into greater concerns, underlying concerns. So what we needed was the catalyst, and now we're moving into the major fundamental theme. All right, we're going to discuss this, and we're going to discuss a lot more about what's coming up this week, including the major event risk that we have on the docket, including the FOMC rate decision. But before I dive in too far, please tell me if you can see and hear, and if we are good to go, you should be looking at the S&P 500. Then I'll dive right into the thick of it. Just give me a Y or a yes. Okay, thanks, guys. All right. So the S&P 500 is, I think, where we need to start because it is one of my favorite measures of risk appetite. Now, it's not always the first to react, nor is it necessarily the perfect measure of sentiment, but it does tap into a number of the things that we need to look for. All right. It is a very big, broad, liquid asset. All right. And knowing that it is a little bit more restrained, unless there is something big enough to move it, it won't move, or it will stick with its major trend, and we know what its major trend has been. Okay. This is also good because it is particularly sensitive to the other big catalyst of monetary or economic performance, capital market performance, and that's monetary policy. So when we look at not just the Fed's efforts, all right, but the Fed's efforts are big and prominent, and that's why we do watch them, but the global stimulus situation, when we look at that stimulus and we see how it impacts the market, all right, that is also a good measure when we're looking to the S&P 500. But we also are starting to pay a little bit more attention to measures like this, the volatility index, and I have a couple of updates for those. We also pay much more attention to the emerging markets. All right, the emerging markets are an interesting situation. Now we're starting to learn a lot about Argentina, aren't we? We're starting to learn a lot about Turkey. We're starting to learn a lot about even Mexico and all those other currencies, the rupee and the rupiah. All right, we had a situation like this not too long ago, actually back in August, where the Indian rupee was seeing massive capital outflows, right, massive, where it was driving the currency up to exceptional heights. Now, what did that do to the standard bearers, the benchmark assets? Did that spread, in other words, to a massive sense of risk aversion for something like this? All right, we didn't really get that level of drive. We did absolutely see a drop. All right, we did have a significant pullback, but we didn't have the scale of risk aversion that would suggest that we are having a market-wide crisis, or even the unleashing of a lot of problems in the backdrop, which I think is what we're starting to look at now. But you did see a very stark and disturbing performance from the emerging markets. All right. Here we have the emerging market volatility index, and you can see back in August when we had that Indian rupee problem, where we did have capital flight, you had a significant jump in that volatility index, and it peaked at its highest level since about June of 2012. All right. Now this is a fragile area for capital. Why do emerging markets matter to the rest of the world? Right? What does it tell us? Well, I did a strategy video specifically on this last week, and you can check it out. But in a broader context, the emerging market is essentially the high dividends of the global market. All right, it's the high rate of return. And we go into the high rate of return, the riskier assets, in other words, when we are looking for higher rate of return, and we're not necessarily concerned about the commensurate volatility. All right, so people will go into emerging markets and bid up emerging markets or drive the volatility or the perceived uncertainty and fear in this market down when they want a steady rate of return, when they want a high rate of return, something competitive, all right? And they're not worried about the risks that come alongside it. Now you can see that they had a pretty consistent performance. We had a pretty strong and aggressive move. In fact, when we look at the broader markets, and this is why I update this graph, all right? This is market performance since the great financial crisis, as we call it, back in 2007, 2008. And you can see that emerging markets, the purple one, this is emerging market ETF, was one of the first and one of the most aggressive to advance. All right. It has since leveled off and started to peak a little bit. Why? Because recognition of problems. All right. And this is something that we have seen for some time, whereas U.S. and global equities continue their persistent advance, emerging markets never really recovered the peak that they had in the first half of 2011. All right. So there have been signs of problems that span very far back. But investors, global investors, didn't necessarily take heed. They just said, all right, now it's time to be a little bit more choosy about what we actually put our capital towards. All right. But recently, we've seen that, yes, they haven't built up their emerging market position, but at the same time now they're starting to really have to pull back on that exposure. All right. Because we do have a very substantial problem in a number of these countries, and it's essentially difficulty in getting your capital out. All right, there's a capital flight. So that money that was put into Argentina, and Argentina is always a hotbed of investor uncertainty. The money that was put into Turkey, the money that was put into South Africa, the more common ones, all right, the Brazilian real, the Indian rupee, all right, these countries are now starting to suffer from the same pandemic. They're suffering from uncertainty that people might not be able to get their money back, and we're starting to learn this morning that there's a possible rate hike in Turkey, right, trying to draw capital back, that they're possibly going to curb, well, they've already tried multiple efforts, but they try to curb outflow of capital from Argentina to zero success. All right. They're trying to do whatever they can to shore up this volatility. Now, the important thing to understand in the emerging markets, we don't need to go much further than that. And if you want to, you can always come and join me in the Q&A tomorrow, and I would be happy to answer whatever I can related to the emerging markets. But the thing to appreciate as we trade our standard pairs, right, like euro dollar or Aussie dollar or pound dollar, or whether we're trading even equities, or if we even want to trade the more sensitive to risk currency pairs, like the dollar yen and the yen crosses. Really, it's the yen crosses. I don't want to put too much emphasis on the dollar yen, because the dollar yen is actually comprised of two quote-unquote safe haven currencies. But the thing to recognize for these stalwarts is whether we have the trigger, the initiator, spread into something far more prominent, far more provocative. All right? Will it actually stoke full-scale risk aversion? All right, where we have a very large unwinding of the standard assets, like the S&P 500, like Euro capital inflows. Euro capital inflows have been a huge factor, huge, because we have seen just like we look at emerging markets, and we discussed emerging markets, investors are putting their money into riskier Argentina or riskier South Africa or riskier India because they know they're at a higher rate of return. But now they're trying to pull out that capital, and they're doing so in a kind of fire in a theater way. People are just flooding out the gates, and that's what's causing such dramatic price movement. All right. If we get that same kind of sentiment, that same kind of fear and panic into other assets, that's where we start to get trouble. Right? That's where it starts to become a market-wide risk aversion theme that would have more dominant impact on these bigger, more robust regions. And the Eurozone, which has pulled in a lot of capital to go to the periphery bonds, people buying Spanish bonds, people buying Italian bonds, Treasury bonds, and Irish bonds, Portuguese bonds, these countries that are actually coming out of their recessions and out from underneath the protection of the Troika. These countries have a lot of capital in them, foreign investment. And that's why these yields, these short-term yields, this is the Spanish and Italian 2-year. I also have the Greek spread, right? It's lowest in years. This is a reflection of investment into those countries, into this region, into the Eurozone. Whereas a year ago, or let's say 2 years ago, be safe, people were talking about this being essentially a crisis of confidence. People in the Eurozone thought maybe one of these countries might leave. Now we're seeing that despite the fact that they have recessions and some of them have unemployment rates over 25%, they're getting record low yields. And that's because capital inflow, strong capital inflow, investors are just trying to get whatever high rate of return they can. These are in the same set of circumstances that we are seeing with the emerging markets. All right? Same situation, different players. The same thing is also true of the S&P 500. Right? Investors plowed in capital into this major index, into stocks in general, into the major asset class, and driven this thing to a multi-year high. And the level of, or record high, the level of intensity to this move is quite extreme. We've seen volatility or expected movement in the market, and typically it's more aggressive when it's a move to the downside. All right, it's shrunk to the lowest we've seen since the period before the financial crisis, and this is not necessarily a natural low. A lot of people think that this is a normal natural low, and it's not a natural low. But we also see volatility has dried up alongside participation, volume. All right, people aren't necessarily participating in this move, and it's a strong reflection of what kind of sentiment is behind this. This move is far too strong, far too overstretched, and based upon very heavily leverage. Right? And there's a lot of leverage out in the market. We know that the equity leverage is at record highs, but the leverage is also very high in traditional assets or assets outside of the S&P 500, but emerging markets, carry trade, all these assets, all these trades that have some kind of element of risk have been driven exceptionally high. Now, if you want to see if this is a major problem, all right, we want to see if this trigger from the emerging markets, all right, it starts with the emerging markets. If it can spill over to the riskier asset class or the riskier measures of FX and equities, etc., and obviously the dollar yen is very sensitive to this, but I think that if you had to measure it, it'd probably be the euro yen that should be the greatest at-risk yen cross. But the Aussie yen, Kiwi yen, CAD yen, the higher yielding yen crosses are certainly far more exposed. But these are going to be the next stage, right? They're very sensitive, and when they start to pull back, that's an indication that the concern, the fear, is spreading. When we see it upgrade to the most stalwart of these asset classes, something like the S&P 500, U.S. equities, which have been driven to consistent heights because of the ongoing support that the Fed has leveraged the market, that's when we start to really undermine the support structure in our confidence. Okay? And if these start to pull back, then we have much greater problems. And we did have that technical break. I was talking about, actually, the day before this break happened, we were talking about inevitable breakouts. All right, and this just happened to be one of them. Though the probability would have been a break for the upside, considering the dominant trend, the reality of a break itself was clear because you have necessarily a terminal wedge. So when you have a terminal wedge like this, a technical Q, you have a fundamental spark, which was the emerging markets, and then we have to pair it up to what kind of market conditions we have, and I like to use market conditions. One, for a strong or weak potential for follow-through. You can see that this was a overall good setup. I would say only 2 of the 3, because strong follow-through is still something not necessarily easy for these capital markets, these financial markets. But we have 2 of those elements, and now we're going to see what happens with the third of them. And if you want to see that escalation, all right, we've seen maybe the first 2 stages. If you want to seriously see an upgrade to this situation, there are a number of other things you can look for. I like looking at the financial markets, all right, the funding markets, really the engine and the support structure that keeps this thing all together. This is actually the level of risk and the level of cost in financing for the Eurozone. Take it in. I put it in the US dollar just because it's the US dollar is considered a safe haven currency, and obviously as the demand for the safe haven currency rises, then you obviously have something that is amiss. But you can see this spread. All right, this is a spread. This is the difference between overnight European funding and ECB-based risk-free funding. All right, so one's market-based, one's ECB set. Now, when the cost starts to rise aggressively and that spread flips, that's when we know that the market is concerned and you're not going to be able to get the funding necessary because people are fearful of troubled financial situations. All right. Specifically for the region, they think that the access to capital, access to funding, is going to dry up. All right. That's a cash crunch. That is a risk. That is a true escalation of the situation. And considering what we said about the Eurozone, where all that capital or all that foreign investment had been filled into the Eurozone periphery, and these risky bonds that are exceptionally low yielding now, but people went to them because they had relatively high yield compared to, let's say, treasuries or JGBs. All right, those are exceptionally risky, and if we see volatility and funding crunch, people will start to cut those positions before they cut any of the meat. All right, you want to cut away the fat before you cut the meat. We'll also be looking for these problems, potential problems, in the U.S. funding market. All right, here we have the difference between the 1 month and 3 month. These are pretty close. Actually, they should be very close in their yield. But when we do have a flip such that people absolutely must have 1 month or 4-week bills, those are about as close to the cash equivalent, as we call it, as we can get. All right, that means people are severely concerned. Now, the severe concern that we had back here was the budget standoff in the United States, but we've had plenty of other uncertainty periods in the past. Right? You can see, obviously, with 2011, that was more related to a financial pinch. And if we went back to 2008, 2007, you would see that that is a liquidity issue, and that's why people were bidding up the cash equivalent. So this is the severity scale. All right? It starts in emerging market, which is really just a trigger. It spills over to the more sensitive of the asset classes. This is not just in the FX market, but there's also sensitive high yield ETFs. There are sensitive volatility ETFs. There are a lot of sensitive markets that are a little bit more sensitive to the more liquid, the more steadfast. When we move into those steadfast asset classes, the ones that were specifically backed by the Federal Reserve, that's the next level. All right, we're starting to spill over here. And of course, I have to include FX on that because the Euro USD is measuring that uncertainty spreading to the capital inflows to Europe and the Eurozone periphery. All right, and you will see the US dollar will revert to its traditional safe haven role. The euro will be construed as a risky, quote unquote, currency once again. All right, so that would be the next level alongside the S&P 500. But when things really get a panic, that's when we hit the funding markets, the cash markets. When the funding markets start to seize up, that's when we have a full-blown crisis. All right, so it's kind of like a levels of denial situation, but to a much greater extreme, a much greater concern. We're looking at these considerations, and we're going to gauge where we're at in the scale, how far we're moving up, whether we're going to actually hit that next level. All right, because if we hit that next level, if let's say we get into financial crisis mode and the funding market seize and people need liquidity at all costs, something like the dollar is going to come into absolute demand. All right, because it represents liquidity. Right, to all the problems that the U.S. has and the U.S. financial sector has, the U.S. dollar represents liquidity. And that's not something that goes away, especially when the markets are panicking. That's where it starts to really shine. So, knowing that we need that absolute liquidity, something like the euro dollar will expect to drop because it does represent a capital flow that we would absolutely suspect through the fundamental performance that it had over the past 9-12 months, where that capital was flowing into the Eurozone thanks to the investment into those high return sovereign bonds from the troubled bailout programs from the Troika. Right, so Portugal, Ireland, Spain. Those are going to be the issues that we look for. All right, if we're looking for the dollar just to crush everything, and I mean everything, it needs to have liquidity. A scale down, if we are just looking for risk aversion, something like yen crosses will be far more sensitive. All right, they will offer far better performance, but they are not going to be something that escalates up to a euro dollar drop. Or perhaps we are looking for something that look just for a bounce, right? A bounce in risk trends that doesn't necessarily help out U.S. equities back to their record highs, but we see that a little bit of the bleeding edge, if you will, of that risk aversion, of that fundamental fear, the liquidity issues in emerging markets, for example. Where would that show its most prominence? Well, first we can look at the emerging market currencies that we actually trade, like the dollar MXN or the dollar ZAR. Those currencies would see a significant bounce because they're somewhat overstretched. Right? But you wouldn't necessarily look into the Euro USD for a strong or just a modest bounce in the most extreme risk currencies. The yen crosses perhaps, and I like the dollar yen above most of the other yen crosses because you have to have some good reason to buy the first currency in the pairing. And for the dollar, we have plenty of reason, and largely because we're coming up on some very major event risk in the upcoming week. All right, and I think that that is the backdrop we need to remember. All right, the scale of risk. This is going to be fundamentally critical to how these markets perform going forward. But there's also major event risk on our docket. All right, these can act as catalysts for the general sentiment scheme, or it can act as individual volatility moments for these particular currencies. All right, so what major event risk are we going to be looking for? What is most important? All right, let's take a look at this week's event risk. And if you're not on my email distribution list, you absolutely can. I put it at the bottom of or in all my articles or my videos. But this is the manic crisis calendar. This is similar to the daily effects calendar, but this has fewer actual events and sometimes very different events. This is more about the event risk that I have a feeling will have an impact on risk reward, all right? That balance of sentiment, whether it be in individual countries, individual regions, or for the broader system. I prefer the system. And when I bold things and I put them as high, and especially when they're marked red, that's when they're very systemically important. You can see I am here on Wednesday, 1900 GMT. This is something I'm actually going to be covering back in Daily FX Plus Live when it happens. But this is the FOMC rate decision. This is the top potential catalyst for the week. Now, we might have a number of news stories related to the emerging markets if Turkey fails to avert capital outflow despite a rate hike, if they go for a rate hike. If Argentina the market outflow becomes critical, all right, that can be another news story. Those are unknowns, probables, but unknowns, and we can't really plan that well for them. I always live by the Boy Scout mantra, expect the best, prepare for the worst, but sometimes in trading you have to really expect the worst and prepare for the worst, but really you have to trade for what's given to you. But this is something that we can benchmark. This is something that we can say we know is important. All right, and the timing is clear. When we know the timing is clear, that is exactly what we need to be prepared for. That is what we need to establish as a market mover. Well, in this fragile situation, a possible second round tapering, because remember back in December 18th, the Fed tapered, and really it wasn't the market response that most of us had expected. I certainly expected, though I knew that was the best time to do it, to minimize the market's response, I didn't expect it to be a follow-through to the upside. All right. This reduction in stimulus, if it is realized, is going to be one more thing that exposes these markets to their own risks. So we're going to see this relationship between monetary policy and the S&P 500 really put to the test. All right. If the S&P 500 is fully depending on growth and the outlook for earnings and yield potential and all that other stuff, then it shouldn't matter that the Fed is removing or curbing, I shouldn't say removing, curbing its support. Okay. But in reality, this support that has been given by the world's largest central bank is critical. This is total stimulus. All right, the Fed balance sheet is a big part of this, but total stimulus versus the volatility index. This is where the relationship comes from. All right, not because, and a lot of people have a lot of problem with this, and as you should, the stimulus that's pumped into the system does not necessarily just feed into stocks, although there are a couple of exceptions, including Japan. The Bank of Japan actually buys outright assets. But it doesn't necessarily do this for the U.S.-based markets. What it really does is reduce risk, perceived risk. If I think that there's going to be little chance of volatility or little chance of, since this is an inverted market, normally the VIX index sits like this. All right, this is how you're usually used to seeing it. But we flip it upside down just like we flip it upside down against the S&P 500, because as volatility drops, we know that the market's perceptions of a S&P 500 drop are reduced substantially. Right? And this is where the positive interest comes. Right? The positive performance of these markets, because we presume that risk is being removed. Now I'm showing you against total stimulus. The Fed is a big part of this, but guess what? What has the ECB done recently? They've had their last rate decision. They've also said, amongst a number of officials, including President Draghi himself, suggested that they don't necessarily need a new LTRO program. All right, they don't need these the liquidity support. All right, dangerous. The Bank of England supposedly looking at rate hikes. All right, the market presumes that there's going to be a rate hike in 2014. The unemployment rate, CPI targets are pretty supportive of that. Then we have the Bank of Japan. The market is really expectant and dependent upon the outlook for a second QE open-ended program upgrade. Right, this is why I keep this updated. This is just a count of performance for the dollar yen, and the light purple line is the performance of the dollar yen from November 1st of 2012, right? And then that's when we had the April Bank of Japan rate decision in which they actually upgraded into an open-ended stimulus program. That was the massive program that the markets had been waiting for. All right, and now we're doing from November 1st, 2013 to current, and we're backing off a little bit. All right, the markets are fearful that the Bank of Japan is not going to follow through on an expansion of that open-ended stimulus program. It's starting to wane. All right, so another of the massive open-ended stimulus program expectations is dropping off. The PBOC, the People's Bank of China, another one that is constantly there. They've recently had to help stabilize the cash market, the 7-day repo rate, and they've also had to essentially, well, it's not confirmed, but rescue a trust that was coming due, and essentially it was on its way to default. All right. And they're putting out little fires that are on the extreme edge, but they're not adding any kind of open-ended stimulus. So all these central banks are backing off. Right? This is very risky, especially when we reach conditions like this, where capital markets are starting to pull back. The underlying capital markets, especially as it comes against more dramatic capital outflows in regions like the emerging markets. All right, so this is going to be, without doubt, the most risky event that we're going to have going forward, the FOMC rate decision. Now, there are other things that we should also be looking for as well, and they are of lesser importance, but that doesn't mean that they are not important. They are very important. Monday happened to be the slow day. All right, so if you thought that it all happened today, this was the slowest day. This is not to be taken as an indication of how the rest of the week is going to develop. On Tuesday, things already start getting more interesting. We have the European Union financiers meeting. We did have the Eurozone today. We have the UK GDP figure. So if you really want to see if the Bank of England can stick it out with no further support, whether they're actually going to be able to contemplate a rate hike in 2014, a lot of it has to do with this. We have U.S. consumer confidence. We have Portugal's economy minister. He's going to be talking about the level of foreign investment into Portugal. That should be an interesting conversation. All right. Then we get into Wednesday, and we know we have the FOMC rate decision, but that's not the only thing I want you to pay attention to. The European Commission is going to release its fifth and final review of the Spanish banking sector. Very important to see all this capital inflow into Spain versus a 25% unemployment rate. All right, big fundamental gap there. We'll see if that gap can really measure up to the financial health of the region. Right? If we see something that says, hey, well, the financial health in this region is not as robust as you investors expected, that's just another reason for people to pull their money out. All right? So that's going to be a big one. The U.S. is going to sell 2-year floating rate notes for the first time ever. Right? And floating rate is not something they typically do. There have been TIPS or inflation-protected treasuries, but floating rate notes they haven't had before. This is going to be interesting also because it establishes how the central bank is looking at inflation, what's going to benchmark against inflation. We would presume that the Treasury's inflation benchmarking would line up nicely with what the Fed is doing. We also have the RB&Z rate decision. This is going to be particularly a huge rate decision. All right, we don't usually look at it as a major driver. I want you to watch this one regardless of whether you trade the Kiwi or not, because this is going to essentially be the first major central bank that is going to reasonably be considering rate hikes. It's been talking about rate hikes, and if investors want higher yield, and they're willing to seek out higher yield at the risk of volatility, they're going to have to see it perform through in these Kiwi-based pairs. Okay, so watch that RB and Z rate decision very closely. It will have a very significant impact on the expectations of the return element on risk reward. Thursday, we get into more event risk, including the Spanish fourth quarter GDP. These two, the Chinese manufacturing and German employment, are going to be short-term market movers. They're not necessarily going to be trend drivers, all right? But the U.S. GDP fourth quarter figure, very important, all right? We get into the very dense round of Japanese data, and national CPI and jobless rate are the two critical figures to be watching here. CPI specifically because if there is going to be an expansion of that QE open-ended stimulus program from the Bank of Japan, they have to see that perhaps their CPI target's not going to be met. All right, but if we get a consistent rise of this CPI, it would suggest that we are seeing an increase in cost pressures at the same time that wage growth is not keeping up. So stoking inflation when your citizens can't afford it is not going to work out. That is not a good policy. That is not a good plan. It's not a workable plan. And then Friday is going to be noteworthy for the same kind of factors that the ECB used to determine a interest rate cut back in November, the unemployment rate and the CPI figures. That's going to be backed also by the first Fed speaker this week, some inflation figures for the U.S., and of course on Saturday we will see Janet Yellen take over the Fed. Bernanke's last day is going to be Friday. His term ends on the 31st of January, and a new regime starts, and this will also be his last central bank rate decision. So we'll have to see what happens with this, but there is a lot of risk this week, both scheduled event risk as well as thematic risk. I want you to be very, very cautious, but more importantly, I also want you to have a plan for trading, when to trade and when to not trade, and also what kind of trades that you're looking for. Whether we're looking for a bounce in risk appetite, where does it play out best? Something like dollar yen. Whether we're just seeing a moderate level of risk aversion that stays kind of in the riskier asset world like emerging markets, that's better played towards the euro yen. All right. Whether we really upgrade the risk aversion appeal, and then it gets into something like the euro dollar. All right. Pay attention to the scale. The scale is extremely important to measuring our trades, measuring how we're trading this market fundamentally. All right. We'll wrap it up there. The recording of this will be on the website shortly, so you can always check it out there. In the meantime, I hope you guys have a great week trading. I hope you come on with a strategy and you play it smartly. That's very important. We'll talk to you once again in this particular forum next week. I will also see you guys back in Daily FX Plus for a Q&A tomorrow and the FOMC rate decision on Wednesday. Good luck trading out there, guys.